Welcome to Making Sense, an investor education program of the Burlington County Library. I'm Carol Glade, a financial educator. Saving and investing are important to financial security both today and in the future. During this video, we'll discuss the difference between saving and investing and look at three basic investment options: stocks, bonds, and mutual funds. All through our lives, it's important to keep learning about money and various ways to save and invest. Every investment and savings product has benefits and limitations. It's important to know which option is best for you. As your money grows, you can explore different options and investment strategies. Before we can talk about investing, we need to discuss the basics of saving. Saving is putting money away to handle short-term needs and emergencies. We all need to have some money available to cover such things as a flat tire, a short-term illness, or an opportunity to do something fun. Investing is putting money away now so it can grow for the future to cover long-term goals. When you invest, you need to think about long-term gains and be able to take responsibility and reasonable risk to earn steady rewards. It's very important to have money saved first in order to invest. Investing is done typically to achieve long-term financial goals, such as funding for a young child's college education or retirement. We may also choose investments that provide a stream of income, typically in retirement. Investing helps build wealth over time. There are several things we must all do before investing, so it's important to have an adequate emergency fund so investments don't need to be sold at a loss to pay for unforeseen expenses. The same holds true for adequate insurance to cover large financial risks, including liability, disability, the destruction of a home, and the loss of a breadwinner's income due to death. Debt balances should be repaid because the interest on debt is such that an APR of 18% on a credit card will probably exceed investment earnings. Smart goals with a deadline date and an estimated cost determine the time frame for investing, which affects the choice of investments we make. An investor's mindset means a willingness to accept the uncertainty that accompanies investing. There's an old saying that life happens. Anyone can get sick, be injured, or lose a job, and having money to cover 6 months' living expenses is important. This amount in savings will form that financial cushion when emergencies and unexpected events take place. If your monthly expenses are $2,000 a month, you'll need to have about $12,000 saved. There are three keys to investing: risk, yield, and liquidity. Keep these 3 points in mind when you make investment decisions. Let's go through each one. Risk is the likelihood of losing some or all of your investment. Generally, as people build assets, they may be able to take higher risks. Every investment has risk. How much risk can you afford to take? Yield is the interest or dividend rate paid on your investment. It's the positive return. Essentially, the higher the yield, the higher the risk. Many investors aim to have various investments at various risk levels, some high, some medium, and some higher risk. Liquidity is how fast you can convert your investment into cash. The most liquid investment would be money held in savings or checking account. These are low-risk investment, and the yield is low, but they are very liquid, and the funds are available immediately. You always want to have some liquid investments because situations will arise in which cash is needed. Everything in life has risk. Sitting in your kitchen drinking a cup of coffee has some risk. However, sitting in the middle of a busy highway is much riskier. Think about your investments in the same way. Every investment has risk. Risk and reward are related. Risk tolerance will change over time as your personal situation changes. There is no such thing as the perfect investment, and every type of investment has some type of risk. The types of risk vary for different types of investments, however. Some causes of investment risks include inflation, economic trends, political uncertainty, business failure, and interest rate changes. The investment risk pyramid diagram depicts the relationship between investment risk and reward. Various types of investments are shown in each of the three sections. The higher one goes up the pyramid, the higher the investment risk and potential return. This is the risk-reward trade-off that investors generally have to make. People with a very conservative risk tolerance will probably want to concentrate their investments at the base of the pyramid. By first understanding your risk tolerance and goals, you can determine which investment options are best for you. The rule of 72 can be used to estimate either the interest rate or the time period that will be required for a sum of money to double. Simply divide one of these two variables into 72 and solve for the unknown variable. The time frame can match the target set for a specific financial goal. If your investment is earning 8%, it will take 9 years to double. Common investments are stocks, bonds, and mutual funds. Let's start with stocks. When you purchase a share of stock, you become a part owner of a company and are considered a shareholder. You essentially make money on stock if the purchase price of a share increases and you sell, or if dividends are paid to stockholders. Dividends are often paid to shareholders from the company's profits. Some stocks fluctuate in price. Others do not fluctuate in price, but pay dividends, which are considered income or capital gains. When buying stock, think about the statement, buy low, sell high. As a stockholder, you may have voting rights to elect directors or to vote on other matters impacting the company. Diversification is one way to offset risk. Diversification means investing in a variety of types of companies. You can diversify your stock investments by spreading your purchases among various industry sectors. Having all your money in one stock has risks, especially if the company does not do well. But investing in a variety of stocks will mean that you are not putting all your eggs in one basket. Bonds are a different type of investment. When you buy a bond, you are lending money to a company or to the government. You do not own the company or government, you are a lender. The bond issuer promises to pay you interest on your loan, so the loan or the bond is an IOU. There are different types of bonds. U.S. Treasury bonds are issued by the federal government. Municipal bonds are issued by larger cities, and corporate bonds are issued by businesses. The higher the risk on the bond, the higher the return. U.S. Treasury bonds are low risk, but they also pay lower returns than corporate bonds. Bond investors must decide on the risk level they want. Bonds are rated by grades similar to those used in school. A AAA bond is less risky than a BBB bond. The AAA bond may pay less, but the risk is also lower. Bonds mature at various times, so try to match the maturity date to your financial goals. And think about the impact of a bond purchase on your taxes. The income on some bonds is tax exempt. If you don't want to select your own stocks and bonds, you may want to invest in a mutual fund. A mutual fund is a professionally managed portfolio of securities such as stocks and bonds. Investors open an account with an investment company and pool their money with other investors. Decisions about which securities the fund purchases are made by the fund manager. Many investors select mutual funds for the first time through their workplace retirement savings plans. This picture shows how a mutual fund works. Advantages of investing in a mutual fund include professional management, diversification, and low initial deposit amounts. Also, mutual funds are very liquid. The disadvantages of investing is that there's no guarantee against market losses and no control over fund distributions and resulting income taxes. Mutual funds do have disadvantages, and investments in mutual funds can go up and down as the market fluctuates. There's no guaranteed rate of return. Because the investments in mutual funds also go up, there are income tax consequences on distributions. But remember, mutual funds are professionally managed, and some fees may be charged. High fund expenses can erode the returns gained, so be sure to check out the fees before you invest. This slide lists 5 key factors to consider in the selection of a mutual fund. A fund that is selected should match an investor's objective, have below average expenses for its fund category, have sustained above average performance compared to peer funds or relevant market indices, have investment policies that align with an investor's personal investment risk tolerance, and any deposit requirements for investors. Investing is putting money aside to grow for the long term, taking reasonable risk. Remember, you can invest once you have an adequate emergency fund saved and available to cover emergency costs and have a low or no debt level. Consider risk, yield, and liquidity as you invest. Risk and reward are related. The higher the risk, the higher the reward. Understand your risk tolerance and know your other assets. When buying stocks, you become an owner of the company. If you buy a bond, you are lending money to the bond issuer. Consider the type of bond you want to buy and the risk you can take. Volatility, or the ups and the downs of every investment, comes with investing. When you purchase a mutual fund, you are pooling your money with other investors and have a professional manager to select investments. Learning about investing is an important step to reaching your financial goals and building wealth. Thanks for joining me today. For information on this and other money management topics, go to the Burlington County Library through the Making Sense website. Visit or contact the Burlington County Library for more information. This program was brought to you by the Burlington County Library with funding from the American Library Association and the FINRA Investor Education Foundation. Thanks for joining me.